Hello and welcome to Investment Insight, your clear take on the markets. Let's get started.
It's great to be here. Although, considering the news, the mood is definitely pretty heavy right now.
Heavy's an understatement. I
Yeah.
mean, we really need to timestamp this conversation because the situation is so fluid.
Yeah, it's changing by the minute.
Right. So it is Sunday, March 1st, 2026. And if you were listening to this, you've probably spent the last, 24 hours doom scrolling just like the rest of us.
Oh, absolutely.
The headlines are just completely dominated by the joint U.S. and Israeli airstrikes on Iran that took place over the weekend. It's a massive escalation.
It is. From a geopolitical standpoint, it's a crisis. But from a financial standpoint, which is really our lane here, it's a massive shock to the system.
Yeah.
I mean, everyone from Wall Street hedge fund managers down to folks just, checking their 401ks on their phone, they're all trying to figure out what happens when the opening bell rings on Monday morning.
Exactly. And that is exactly why we are doing this deep dive today. Because I think most of us, especially here in the U.S., we have this investment 101 textbook in our heads.
Right, the classic playbook.
Yeah, it's almost muscle memory at this point.
Mm.
The rule goes, a war starts, people get scared, they sell all the risky stuff, and they buy U.S. dollars.
Yep.
The dollar is the bunker. It's the ultimate safety blanket.
That is the classic rule. It really has been the playbook since World War II. When tanks roll or missiles fly, the world buys dollars. But
But there's a catch.
there is a big catch. And this is really the crucial part of today's deep dive. If you look at the actual data coming out, recent analysis from over the last 12 hours or so, that old rule might actually be broken.
Broken. Okay, that's a really big claim. You're saying the U.S. dollar isn't the safety blanket anymore.
Well, it's not that it's worthless, obviously. I mean, it's still the dollar. But its absolute dominance, that ironclad guarantee that it acts as the singular go-to refuge during a crisis that is wobbling. Yeah. Looking at the data, we are seeing a structural shift in how money moves during a war.
Okay, let's unpack this.
Yeah.
Because if the dollar isn't the automatic go-to, then we have a practical problem. Money has to go somewhere, right?
Right. It doesn't just evaporate.
Exactly. If I'm a big institutional investor and I'm scared out of my mind, I'm not just going to stuff billions of dollars under a giant mattress.
No, you definitely are.
So where's the capital flowing? And, why is the king of currencies looking so shaky on the throne right now?
To answer that, we really have to look at what we call the true thermometers of fear in the market. And right now, according to the research, that is not the dollar. It is the Japanese yen and the Swiss francs.
The yen and the francs.
Yeah.
Okay, I hear this from currency traders sometimes, but for those of us who just have a standard savings account or a basic stock portfolio, why these two?
It's a fair question.
And is it just because Switzerland is famous for being neutral?
Well, that's definitely part of the psychology for the Swiss franc, yes. But the main reason, specifically when we talk about the Japanese yen, is purely mechanical. It's about something called the carry trade.
The carry trade.
Right. And a concept called deleveraging.
Deleveraging. Okay, that sounds like intense corporate jargon. Let's break that down for the beginner who's just trying to understand their portfolio.
Okay, sure. Let's use a really simple analogy. Imagine the global financial market is a giant neighborhood party.
Okay, I'm at the party.
Right. When the weather is nice, when the economy is growing, the world is peaceful, inflation is low, investors want to go out and have fun. They want to buy risky things that pay really high returns.
Like fancy tech stocks here in the U.S.?
Exactly. U.S. tech stocks or maybe high-yield bonds in emerging markets.
Sure, because everyone wants those high returns when times are good.
Right. But to buy those expensive high-return stocks, these big investors need cash. So where do they get it? They go to the places where borrowing money is incredibly cheap.
Oh, I see where this is going.
Yeah. For years, that has been Japan and Switzerland. Their central banks kept interest rates at rock bottom, sometimes even negative.
Okay, so let me make sure I'm getting this.
Yeah.
I basically go to Japan and I borrow a massive bunch of yen effectively for free.
Exactly. You borrow the yen, you convert it into dollars, and you go buy your high-flying U.S. tech stocks. That is the carry trade. You are literally carrying the money from a cheap place to a highly profitable place.
So the whole financial world is effectively shorting the yen to fund this massive party.
That is a perfect way to put it. Yes.
But then
Then the airstrikes happen.
the party stops.
The music cuts out instantly. Suddenly, you do not care about making a 10% gain on a tech stock. You just want to survive the storm. You need to pay back your loans before things get completely out of hand. So what do?
Well, I guess I have to sell the tech stock, take whatever cash I can get, and oh, wait, I have to buy back the yen to pay off that original debt.
Bingo. You, along with thousands of other massive financial institutions, are all rushing to buy back the yen at the exact same time so you can close out your loans.
And that massive buying frenzy is what drives the price up.
Yes, that is deleveraging in action. It drives the price of the yen through the roof.
That is fascinating. So when I turn on the news and see the yen spiking, it's not because Japan's economy suddenly cured cancer or had a massive boom overnight.
Not at all.
It's because everyone is rushing to the exits to pay back their debts because they are absolutely terrified.
Precisely. It is the purest fear gauge we have. And looking at the data from the Asian market open right after the strikes this weekend, the fire alarm is screaming.
What are the numbers showing?
Well, the yen and the Swiss franc surged immediately across the board. In fact, if you look at the euro, it dropped against the Swiss franc to its lowest level since 2015.
Wow. 2015, I remember that. That was a wildly chaotic year for the franc, so the alarm is definitely ringing loud.
It is ringing very, very loud.
Okay, so I completely get why the yen and the francs are shooting up. That's just the raw mechanics of fear and debt. But usually, the US dollar rallies right alongside them, right?
Historically, yes.
Because we're the biggest economy, we have the world's reserve currency. So why are you saying it's different this time? Why isn't the dollar joining this safety party?
This is where things get really fascinating. Traditionally, yes, the dollar is the undisputed king of safety. But recent analysis, specifically looking at macro trends from 2025 into right now in 2026, shows the dollar is actually suffering from an identity crisis.
An identity crisis.
For a currency.
Yes. The data suggests the dollar is losing its absolute risk-free status. And it's because of two main factors originating right here at home in the U.S.
Okay, what are they?
First, we have what analysts politely call unpredictable trade policy. And second, there are growing questions about the independence of the Federal Reserve. Okay, let's tackle the policy part first. We have President Trump in office right now, and we know this administration heavily favors tariffs and very aggressive trade negotiations. I mean, we see the headlines every day.
Exactly. And look, whether you agree with the politics of that or not, we have to look at it from a cold, hard market perspective. And from that perspective, markets simply hate uncertainty.
Right, they want to know what the rules are.
Exactly. If trade policy can change via a sudden announcement or a midnight post on social media, it creates extreme volatility. If a currency's value can swing wildly just because of a sudden tariff threat on a major trading partner,
It stops being a boring, safe thing.
exactly. It stops looking like a reliable store of value and it starts looking like a speculative bet.
That makes a lot of sense. If I'm looking for a bunker, I don't want excitement. I want boring. I want solid concrete.
Correct. You want boring. And then you have the Federal Reserve factor. The Fed controls the U.S. money supply. For global investors to truly trust the dollar, they need to believe the Fed is making its decisions based purely on economic data.
Like looking at inflation numbers and job reports.
Right. Not making decisions because of intense political pressure from the White House to lower rates before an election, for example.
So if global investors start feeling like the referee is wearing one team's jersey, they just stop trusting the entire game.
That is a perfect analogy. So think of the dollar like a house. For decades, it used to be a boring, unbelievably sturdy brick house. You knew it would stand up to a hurricane. Now, imagine that exact same brick house, but you suddenly realize it's built directly on top of an active earthquake fault line.
Ooh.
The house itself is still strong. It's still the U.S. dollar, the biggest economy in the world. But the foundation feels incredibly shaky because of our national debt, the sudden tariffs, and the general political volatility.
So if I'm a foreign investor, I'm looking at this and thinking, yeah, the house is strong, but do I really want to be standing inside it if the ground suddenly opens up?
Exactly. You start looking for alternatives. And because of that underlying foundational risk, investors are now demanding a premium. They basically need a discount or an extra reward just to hold the dollar. And we actually saw hard evidence of this right before the weekend strikes.
Really? Before the strikes even happened?
Yes. According to a recent analysis from just last week, February 23rd, during the Asian trading sessions, there was a lot of confusion over some new tariff rumors and some hotter than expected inflation data.
So a mini panic.
Right. Panic ticked up. But the dollar actually weakened against the safe currencies like the yen and the franc during that session.
Wait, panic went up, but the dollar went down against the safe havens. That is the smoking gun right there, isn't it?
It absolutely is. The old reliable formula of crisis equals strong dollar is clearly cracking. The market is starting to treat U.S. policy as part of the global risk rather than the solution to it.
That is a massive, massive shift in how the world works. I want to dig a bit deeper into why this happens in a war scenario specifically. You mentioned earlier there are three specific scenarios where the dollar might not rally at all. Let's break those down for the listener,
Right. Scenario one is what analysts are calling the U.S. as the source of stress.
which ties directly back to the conflict we're seeing right now.
Yes. If the market believes that U.S. policy choices, or in this case, direct U.S. military involvement in the airstrikes, are what actually caused the geopolitical risk to spike, the dollar doesn't get that automatic safety boost.
Because it's too close to the blast zone.
Exactly. It essentially becomes the protagonist of the problem.
Right. Going back to your house analogy, if the arsonist is hiding inside the brick house, you don't run into the brick house for safety when the neighborhood catches fire. You run to the neighbor's house.
That's right. You run to Switzerland or you run to Japan.
Okay, that makes perfect sense. What is scenario two?
Scenario two sounds like a pure economic nightmare. It's stagflation driven by an oil shock.
Stagflation. Okay, we hear that word thrown around on financial news all the time, but let's define it.
This is the big trap, and to understand it, we have to look directly at oil prices. Following the airstrikes this weekend, oil didn't just tick up a little bit. It spiked roughly 10% almost instantly.
Which every single listener is going to feel at the gas pump by tomorrow morning.
They absolutely will, and here is why that is so terrible for the dollar. High oil prices act exactly like a massive tax on the consumer. They suck money right out of your pocket.
Because if I'm paying $60 to fill my tank instead of 40, that's $20. I'm not spending at a local restaurant or buying stuff online.
Exactly. So consumer spending drops, and that slows down the entire economy. That is a stag part of stagflation. Stagnation. Growth dies.
But at the same exact time, oil is used to transport everything. So it makes groceries, clothes, everything more expensive.
Right, and that is the inflation part. Inflation. Prices are soaring while growth is dying. So now, put yourself in the shoes of the Federal Reserve. You are watching the economy slow down, so the textbook says you should cut interest rates to make borrowing cheaper and help businesses grow.
Right.
But you also have exploding inflation from the oil shock, so the textbook says you should raise interest rates to cool down the economy and stop prices from rising.
Oh, man. You're totally stuck. Can't do both.
You are paralyzed. It's exactly like trying to drive a car with one foot slamming on the gas and the other foot slamming on the brake.
That sounds like a great way to blow the transmission.
It is, and global investors hate that paralysis. They look at the US dollar and they just see a very messy, complicated situation. Then they look at the Swiss franc, where the inflation dynamic isn't quite as bad because of how their economy is structured, and they say, I'll go there instead. It's just cleaner.
That makes total sense. The dollar just comes with too much baggage right now. So what's the third scenario?
Scenario 3 is known as the fear of the backfire, or sometimes traders call it the wrecking ball effect.
The wrecking ball. That sounds dramatic. Who is getting wrecked here?
The entire global financial plumbing. You have to remember, there are developing countries out there, places like Brazil, Turkey, Indonesia, and they owe trillions of dollars in national and corporate debt.
Okay.
But a huge chunk of that debt is denominated in U.S. dollars. Yeah.
So they have to pay those loans back in U.S. dollars, but they are collecting taxes and earning revenue in their own local currency.
Right. In reals or lira or rupiah. So if the U.S. dollar suddenly gets massively strong because of a panic rally, their debt payments instantly become incredibly expensive.
Because their local money buys fewer dollars.
Yeah.
It's like if my monthly mortgage payment suddenly doubled overnight just because the bank changed the exchange rate.
Exactly. And what happens if your mortgage doubles overnight?
I can't pay it. I default.
Right. They default. And if all these emerging markets default at the same time...
Then the U.S. and European banks that lent them the money in the first place take massive catastrophic losses.
Exactly. It comes right back to hit us. A recent analysis noted that a super strong dollar could easily trigger a massive wave of defaults, which leads to a sell-off in U.S. assets to cover the losses.
So it's a giant boomerang. If the dollar rallies too hard, it acts like a wrecking ball on the global economy, and then the rubble falls right back on our own heads.
That is exactly the fear. And smart institutional investors know this. They hesitate to buy the dollar in a panic because they know if everyone piles in, the whole global system might actually snap. It's a sort of self-correcting fear mechanism.
Man, this is really a lot to process. We have the U.S. as the potential source of the stress, the stagflation oil shock trap paralyzing the Fed, and the fear of the dollar wrecking the global economy.
It really is a complete paradigm shift from what we were taught 10 years ago.
So let's bring this all down to earth for the listener.
Mhm.
I'm sitting at home, I'm reading these scary headlines, maybe I'm looking at my retirement account. How do I know what's actually happening out there? How do I know if this is a full-blown hide-in-the-bunker panic where I need to be worried, or just a really volatile news week?
That is exactly the right question to ask. And the answer is you can't just look at the stock market. The stock market can be irrational. You need a specific dashboard. And we recommend looking at it in two layers.
Two layers. Okay, walk me through layer A.
Layer A is what we call the panic check. This is where you look at those pure thermometers we talked about earlier, specifically the US dollar to Japanese yen pair and the euro to Swiss franc pair.
Okay, so I'm checking the yen and the franc. What exactly am I looking for on the screen?
You are looking for a sharp, sudden spike in their value. If the yen and the franc are shooting up, and specifically if you see the euro crashing against the Swiss franc, the fire alarm is real.
Okay.
That tells you that the big money, the smart institutional money, is aggressively deleveraging. They are genuinely scared.
Okay. So if I see the franc skyrocketing, I know the fire is definitely burning. That's layer A. What is layer B?
Layer B is the trust check. This is where the nuance really comes in. You need to look at how the US dollar is performing relative to those specific safe currencies.
So comparing the dollar directly to the yen and the franc.
Exactly. If the panic is high, meaning layer A is flashing bright red, but the dollar is not rising against the yen, that is the crucial signal.
It means they aren't treating the dollar as the lifeboat anymore.
Correct. It means the market is explicitly rejecting the dollar as a shelter in this specific storm. And honestly, looking at the recent analysis regarding this weekend's events, that is exactly what we are seeing play out.
Why?
Geopolitical risk is at a multi-year high, but the dollar isn't winning against the other safe havens.
It's like everyone is running out of the burning neighborhood, but they are sprinting right past the big brick house to get to the smaller bunker down the street.
That is a perfect visualization, and that tells you a whole lot about how much trust the global market actually has in the brick house right now.
This really completely changes the strategy for a regular investor. You can't just blindly assume that buy American is the safe play when the whole world gets crazy.
No, you absolutely cannot. In fact, experts are suggesting an entirely new way to look at portfolio safety. We call it the triangle of safety.
I really like a good framework. What's in this triangle?
Well, since you can no longer just buy dollars and go to sleep, you have to watch three specific points. Point one is pure fear. That's the yen and the Swiss franc. Are people actively deleveraging?
Okay, so check the fear gauges. Got it. What's point two?
Point two is U.S. rates. Specifically, what is the Treasury bond market doing? Normally, if global investors are scared, they should be buying U.S. government bonds as a safe place to park cash.
And when people buy bonds, it pushes the interest rates down.
Exactly. But if you look at the screen and interest rates are actually rising while the world is on fire, that means people are actively selling U.S. debt. That is a major flashing warning sign.
Because that would mean they don't want our debt and they don't want our currency either.
Okay.
And point three of the triangle.
Point three is oil. Is the inflation and growth shock getting worse? Because if oil keeps spiking up 15–20%, that stagflation scenario we talked about becomes the dominant reality.
Right.
And as we discussed, stagflation is absolute kryptonite for the US dollar.
So it's fear, which is the yen,
Yeah.
trust, which is the treasury rates, and inflation, which is oil. That's the new dashboard.
That is the dashboard for the modern global crisis.
Man, this has been incredibly eye-opening. We started this deep dive talking about airstrikes on Iran, a very kinetic military geopolitical event, and we ended up fundamentally rethinking the entire role of the U.S. currency.
It really highlights how deeply interconnected everything is now. You simply cannot separate the geopolitical map from the movement of money.
You really can't. And, this raises a really profound question for me as we wrap this up. We've spent decades, literally my entire life, assuming the U.S. dollar is the absolute bedrock of the world, the one constant you could always rely on.
Right.
But listening to all this today and looking at the data from this weekend, well, it feels like we are entering a new era where the U.S. dollar is no longer just a neutral currency. It's become a geopolitical poker chip.
That is a really fascinating way to frame it.
Think about it. Between the tariffs, the financial sanctions, the mounting national debt, it's increasingly being used as a tool or a weapon or just a bargaining chip in global negotiations.
Yes, it is.
And if the dollar stops being the world's ultimate safety net, if it stops being that purely neutral place to just park your money when you're scared,
Hmm.
where does all that massive wealth go next?
That is the trillion-dollar question,
Hmm.
literally. If the core trust erodes, the capital has to find a new home. We're seeing early glimpses of it with the franc and the yen right now, but can those small economies really hold the entire world's panic money?
What is that?
No, probably not. It suggests we might be heading toward a much more fragmented future for the global economy, a world with multiple smaller safe havens instead of one big one.
A fragmented future. Wow, well, that sounds like a massive topic for another deep dive entirely.
Indeed, it does. We'll have to come back to that one.
Well, in the meantime, we will definitely be watching those charts, the yen, the franc, and oil, very closely this week. And we hope you will too, now that you have the dashboard and know exactly what to look for.
Stay safe out there, everyone, and keep an eye on the data. It's going to be a wild week.
Thanks for listening. Don't forget to subscribe and hit that like button. We'll see you next time.